Pound dollar delivered one of its most dramatic performance in over a decade in 2025. The pair collapsed to 15-month lows in January, then surged to a nearly 4-year high somewhere in July before closing the year up around 7%. That volatility wasn't just random. It was largely driven by the US dollar dynamics shaped by Trump's 2.0 protectionist agenda. Now, as we enter into 2026, the key question is, what comes next? A likely Fed and Bank of England monetary policy divergence, a softening macroeconomic backdrop, and renewed political uncertainty in the United Kingdom could reshape the fundamental landscape. Hi, I'm Dhwani Mehta, and I'll break down key macro drivers and the long-term technical framework to assess where pound dollar could be headed in 2026. Pound dollar hovered near 3-month highs above 1.3500 in the final trading week of 2025. The move has been sponsored by persistent bearish pressure on the US dollar. At the same time, improving risk sentiment, fueled by signs of progress in Ukraine peace talks involving Trump and European leaders, has helped the major preserve its bullish momentum. Let's turn to 3 core fundamental catalysts that could affect pound dollar in 2026. First, Fed and the Bank of England rate outlook. Both Fed and BOE have moved deeper into easing mode, shaping expectations for the year ahead. In December, Fed delivered its third straight 25 basis point cut, lowering rates to 3.5 to 3.75% with dissent from 3 FOMC members. Policymakers currently project just one cut in 2026, while markets are pricing in close to 60 basis points of easing. That gap reflects expectations of a more dovish Fed as Jerome Powell ends his term in May 2026, alongside speculations that Trump-backed successor would favor lower rates. Meanwhile, the Bank of England lowered its benchmark bank rate to 3.75% in December, delivering a total of 100 basis points of easing since August 2024. While officials signal greater caution as rates approach neutral, weaker growth, cooling inflation, and rising unemployment keep expectations alive for another rate cut in 2026. Second, the US and UK macro picture. US economic prospects remain uncertain despite the strong headline growth, with the third quarter initial GDP estimated at 4.3%. Labor market is cooling, with unemployment rising to a 4-year high of 4.6% and core inflation eased to 2.6%. Together, these trends support expectations that slacker labor market conditions could justify further Fed rate cuts in 2026. In the UK, data flow remains challenging. GDP stagnated between August and October, the trade deficit widened, and inflation cooled to 3.2% while unemployment climbed to 5.1%. That said, markets see some relief from Chancellor Rachel Reeves' decision to increase fiscal headroom in the budget, which could help reduce economic uncertainty in the coming year. Adding to that cautiously optimistic view, KPMG's UK chief economist Yael Selfin noted that the increase in private sector and government investment could support growth, limiting how dovish BOE could potentially become. The third factor being the UK political volatility. The UK political uncertainty remains a key downside risk for the pound sterling. Prime Minister Keir Starmer faces mounting pressures over immigration and economic performance, and lingering questions surrounding his leadership could continue to inject volatility in both politics and gilt markets. Reports that the labeling groups are exploring alternative leadership options have further fueled speculation that a challenge could emerge in 2026, particularly if the local election results disappoint. Looking at the pound dollar monthly chart, the major has carved out a bullish ascending triangle throughout 2025, pointing to an upside bias into early 2026. The momentum supports the structure with a relative strength index well above the 50 level. A monthly close above the horizontal resistance or the triangle resistance near 1.3785 would confirm a bullish breakout from the triangle, exposing the 1.4000 round level. Beyond that, the 200-month simple moving average at 1.4143 will come into play. On the downside, the immediate critical support is seen at the rising trend line or the triangle support at around 1.3100. A sustained break below this level will negate the bullish technical setup and shift focus back towards the 50-month simple moving average support at 1.2723. The next key supports are seen at around 1.2500 psychological level, and then the January 2025 low near 1.2100. All in all, pound dollar remains structurally supported in 2026 as expectations of deeper Fed easing relative to the BOE could outweigh UK political and economic risks. Now, unless the US labor market conditions improve significantly, the monetary policy divergence narrative combined with a constructive long-term technical setup keeps the upside intact. So, are you bullish or bearish on pound dollar in 2026? And which level are you watching most closely? Let me know in the comments, and don't forget to like, share, and subscribe to FX Street.